$35 for a cup of coffee. Not a mistake, not a scam, not a stolen card. A $3 coffee, a balance reading $2.80, and a paycheck that landed 11 hours later. The coffee cost $3. The bank charged $35. And here is the part that should bother you. The smaller your balance, the more this machine earns from you.
4 places where it leaks today, each with a number on it. The order your payments are posted in, the favor you were asked to accept, a price that ignores what you bought, and a meter that keeps running while you wait. I am not going to tell you what to do with your money. I am going to show you how the part is built. 4 leaks, 1 thin balance. Pop the hood. First, the order your payments are posted in. Marcus, 31, works a warehouse floor at $18 an hour. Thursday evening, he has $2.80 left and 3 small things still to pay. The coffee at $3, a bus top-up at $2.50, a phone bill at $120 on autopay. $6.70 going out, $2.80 sitting there. His wages land Friday, 7 in the morning. Well, 7 if the payroll run behaves. 3 small things, 1 short night. Watch the clock. Here is how it works. Those 3 payments do not have to be posted in the order he made them. A bank chooses the order, and because it may post the biggest one first, the account can empty before the small ones arrive. 1 shortfall becomes 3 overdrawn payments instead of 1. Same money, same night, same man. Different arithmetic. Look right here. The 3rd line down. Do you see it? Count them. 3 fees, $35 each. $105 for being short by about $4 for 1 night. At $18 an hour, that is nearly 6 hours of warehouse floor. 6 hours for a gap that closed by itself before he woke up. Reordering payments has been argued in courts, curtailed at some banks, and quietly kept at others. Look at what that tells you. Nobody had to break anything for Marcus to lose 6 hours. The sequence was a setting, and somebody set it that way, because a fee that fires 3 times pays better than one that fires once. The order is not a glitch, working as designed. But none of that order matters unless the bank agrees to pay a card that has nothing behind it. It does not have to. It can decline the coffee for free, and Marcus walks out annoyed and $3 richer. So why does the coffee go through? Because somewhere, once, he was offered a favor. Second, why the payment went through at all. Since 2010, a bank in the United States has to ask before it covers your debit card into the red. You say yes, and that yes never arrives as a warning. It arrives as protection. It just means your card won't get declined at the till, says the pleasant person opening your account, and she is not lying. A box on a screen worded like a seatbelt. Read that box again. What does yes actually buy? Not more money. It buys the transaction going through instead of being refused. So the product is the arriving itself. A $3 coffee lands and the landing cost $35. The alternative was free and mildly embarrassing. One of those 2 outcomes has a price list. Just don't spend money you haven't got. The customer at the lift says it before I do, and honestly, it is the fair objection. Put it on the scale. In the data, a typical debit overdraft is a purchase of around $24, not a spree, a tank of petrol, a shop, a lunch. The needle does not argue with anybody. Around $24, and the charge for it is around $35. Read those 2 numbers next to each other, slowly, or rather, read them twice. The fee is bigger than the thing you bought, not a percentage of it, bigger than it. And it is the same 35 whether the number underneath is 24 or 240. That flatness is the 3rd thing, and it is the strangest part of the whole machine. Every other price moves with size, petrol, rent, a taxi, a kilo of apples. Double the thing, double the bill. Not here. This one does not care what you bought at all. And that is deliberate. A flat number is easier to collect from a thin balance than a percentage is. Third, and here it gets strange, price it the way the bank would price anything else it lends. Marcus borrowed about $24 without asking for roughly 3 days. He paid $35 for the use of it. Turn that into an annual rate, the way a loan is quoted, and the arithmetic stops looking like a fee, roughly 17,000% a year. Same money, different label. That is not a typo, and to be exact, it is not outrage either. It is division. Any lender quoting that number on a shop front would be shut by lunchtime.
The same number, charged as a fee instead of interest, arrives on your statement as a single tidy line. A price that ignores the size of what you bought is not sloppy pricing. Sloppy pricing loses money. This one is stable and predictable precisely because it ignores size, which means the smallest customers carry it. This is not an oversight. Working as designed. Worse, the clock does not stop when the coffee is drunk. Marcus is now overdrawn, waiting for Friday morning to fix it. He is short by the fee itself, which is larger than the gap that caused it, which is where the fourth one lives. What happens while you are waiting?
Fourth, what happens while you wait?
Many accounts carry a second charge for staying overdrawn, a sustained fee, $10 or $15, applied after 5 or 7 days in the red. It is not a fee for spending, it is a fee for not yet having fixed the first fee, or rather, a fee bigger than the gap that caused it. Now hold that statement up. I mean it. Read the dates, not the amounts. For a man who was $4 short for one night, the machine can bill the shortfall, bill the order it chose to post things in, and then bill the delay. 3 different lines, 1 gap. And the only thing he did differently from his neighbor was the day his wages arrive. Put the coffee back on the scale. $3 of coffee, $35 for the arriving, and, if Friday had gone wrong, $15 more for the waiting. $50. At $18 an hour, that is most of a shift for a drink he finished before the bus came. So who is actually paying for all this? Not everybody, evenly. That assumption is worth taking apart because it keeps the whole thing quiet. Most people never meet these fees at all, and that is not luck. It is because a cushion of $200 makes the whole thing invisible. Here is the twist, and if you keep one number from today, keep this one. In the American data, a small slice of accounts, around 9 in 100, pays roughly 8 out of every $10 of overdraft fees. The machine is not funded by careless spenders. It is funded by thin balances. 9 in 100. And the size of it. Banks in the United States collected something like $5.8 billion in a recent year from overdraft and its cousin, the returned payment fee, down from about $12.5 billion in 2019. Half the take gone. That fall did not happen because customers got richer. Rules changed, and some banks dropped the fee to compete. Back to Marcus, with all 4 of them running at once. $280 in the account, wages 11 hours out, a coffee at a counter. The order was set before he arrived. His yes was collected years ago, on a screen worded like a seatbelt. Its price ignored the coffee. That meter ran while he slept. All 4 of them worked. The only part never fitted inside the case is the switch marked Opt Out. It belongs to the driver. £3 of coffee, $35 to have it. That is Marcus with his own statement in front of him, and he is right. It was never a story about coffee. It is a price attached to the moment you have leased, charged in the hours before the money arrives. Marcus drank a coffee. What he paid for was the timing of his own wages. Your number. Open 12 months of statements. Count only the lines that say fee. Add them into one number and put it in the comments. One number. I read every single one of them. Subscribe if you want this taken apart once a week. And straight up, this is how the thing is built, not advice. Your own numbers decide, not mine. Next on the list, the account that pays you interest and takes it back through the side door.